Hello everybody, my name is Polina Petrova and today I will be presenting gross income. So, according to Section 61 Internal Revenue Code, gross income is income from whatever source derived. Today I will be talking just for three things: gifts, employee fringe benefits, and most for meals and lodging, and discharge of debt. Section 102 of Internal Revenue Code states that gifts are not income. And I would like to talk about a case that I find it's very interesting. It's Commissioner versus Duberstein. I'll start with the rule of law. It says that a transfer is not a gift if it's made out of obligation or anticipation of future benefits. So here are the facts. Duberstein was the president of a metal company and Berman was the president of another company. Both taxpayers were conducting business between each other. And Berman, he was often asking Duberstein to provide a list with potential clients. Once Duberstein did provide such a list, which turned out to be very beneficial for Berman, as a thank you, Berman decided to provide Duberstein with a car. Duberstein accepted the car as a gift and did not include its value in its tax return. But Berman included the car's value in his tax return as a business expense. So the issue that is presented is the value of the car excluded from gross income? No, it's not. The rule is that gifts received are excluded from gross income, but the question is how to determine whether something is a gift or not. If the transfer is made from a sense of obligation or in exchange for services, the transfer is not a gift. And to be considered a gift, the transfer must be made out of detached and disinterested generosity. Here we should look at transferor's intent, so to determine whether it's a gift or not. Cross decision. Although Duberstein and Berman characterized the transfer as a gift, and although Berman had no legal or moral obligation to make the transfer, the trial court found that the transfer was not a gift. They ruled basically based on the fact that the transfer was made primarily in response to the assistance provided by Duberstein or perhaps to secure Duberstein's continued assistance. So if Duberstein didn't provide the list, most likely Berman wouldn't have given him a car. The next category is employee fringe benefits, and it's meals and lodging. Section 119, subsection A, states that the value of meals and lodging of an employee are excluded from gross income if there is a test that needs to be met in order the value to be excluded from gross income. And here is the test. First, if it's for the benefit or convenience of the employer. Second, meals and lodging are furnished on the employer's premises. And third, the employee is required to accept the meals or lodging as a condition of employment. Again, I found a case that I think it presents very well this concept. It's Herbert Hatt versus Commissioner. Here are the facts. Hatt married Dorothy, who was the president of a funeral home in Indiana. She transferred significant part of her shares in the company to Hatt. Both of them were living in an apartment in the same building where the funeral home was. After hours, Hatt was handling business calls and was meeting customers in his apartment. It was common a person to live in the same building where the funeral home is to better accommodate customers. Hatt and Dorothy wanted to exclude the lodging from their gross income, and the issue how, should Hatt be allowed to exclude the value of the lodging from gross income. Here is some discussion. The tax court noted that the nature of the funeral business required 24-hour supervision. A designated employee lived on the premises of every other funeral business in town. He took calls and handled business in the apartment. All three elements here are met. The lodging was furnished on the employer's premises. As we noticed, the apartment is in the same building where the funeral home is. It's for the convenience of the employer. The company has an interest this person to live there so he can handle business after hours. Employee is still conducting significant part of his duties in his apartment, and him living in this apartment was a condition of employment. There is something to note here. If employee was the employer, the lodging would not be exempt. Employer and employee must be separate. But here, the taxpayer was a shareholder in a corporation that employed him, but the company is a separate legal entity, so we don't have that issue here. The last thing that I will talk about is discharge of debt. Discharge of debt is income. Exception here is bankruptcy and insolvency. Income received as a loan is not an income for the receiver. The last case that represents discharge of debt is U.S. versus Kirby Lumber. Kirby Lumber was a president of a company. He wanted to borrow money, so he decided to issue bonds in amount of almost $12 million. Later in the year, when the prices went down, Kirby bought some of the bonds back for less than their original value. Ultimately, Kirby saved almost $138,000. The issue is, does a corporation that buys back a bond at less than its issuing prices realize taxable income? What do you think? Yes. A corporation that issues bond and later purchases that bond at less than its issuing price is essentially discharge of a portion of its debt. Thus, the difference between the issuing price and the purchase price is taxable income to the corporation. Thank you so much, everybody, for watching. I hope it was interesting and informative.